So we are still on inventory accounting. This is CN Professional Institute. In the previous video, we looked at the subsequent measurement of inventory, which we said inventories are subsequently measured at the lower of cost and net realizable value. We looked at how to account for inventory write-down and then some of the factors or conditions that account for a write-down. And then finally, we looked at how to reverse a write-down. And so when the conditions that cause the write-down are reversed, how do you account for it in the books, right? So we looked at how to treat write-downs and then the reversal of write-downs in our previous videos. In this video, we are going to solve more questions and then we'll proceed with our cost formulas, right? So let's solve more questions, okay, on the subsequent measurement of inventory and then how to account for inventory write-downs, right? So let's continue. Let's continue with our questions, okay? Good. So we are going to continue with question 5. We solved some of these questions already. So let's continue with question 5. Question 5, okay. So question 5, it's here, a very nice question. So let's increase this here. Let's bring this here small so that you can have a better view, okay. So we have question 5. Okay, so question 5 says, Rich Auntie Enterprise has 3 products in its inventory as follows. Right? So we have the product, the cost, and then the net realizable value. And the requirement is at what value should the inventory be stated in the statement of financial position of Rich Auntie in accordance with IAS 2, right? So in accordance with IAS 2, at what value should the inventory be recorded in the books of Rich Auntie? We have the total cost to be 33,000, total NRV to be 36,000. But what we've learned from the previous video is that to value inventories, we have to do it on a line-by-line basis, right? What it means is that we don't pick the total cost 33,000 and come and compare with the total NRV 36,000. No, right? We have to do it line by line, meaning that if you pick product A, compare its cost with its NRV. When you pick product B, compare its cost with NRV and pick the lower, right? So we are not going to come and pick the total, but we have to pick the figures line by line. I mean, value them line by line. Okay, so don't compare this 33,000 with the 36,000 and pick 33,000 as the value because that's a lower. No, the standard says we should value them on a line by line basis, right? Meaning that we have to work them out separately, right? So let's bring a Ghana city sign here, okay, so that we know that all our computations are in the Ghanaian city. Okay, so I have my city sign here, right? Now let's continue. So we pick product A. So picking product A, what is the cost of A? 10,000. NRV is what? 12,000. So cost is 10,000. NRV is what? 12,000. So which one is the lower? The lower is what? 10,000. And that's what we are going to pick as the value of the inventory. You can see we are doing it on a line by line basis. We are doing a line by line basis because we are picking each inventory and then we are valuing it. Then we pick B. So let's pick B, product B, right? If you pick product B, so if you pick product B, what is the cost? You see that the cost is what? 11,000. NRV is what? 15,000, right? So this is what I'm talking about. 11,000 as the cost, NRV 15. So we pick the lower, right? Which is what? 11,000. Then we go to the next item, product C. You go to product C. What is the cost of product C? Product C, the cost is 12,000. Here, NRV cost 12,000. NRV 9,000. That's the net realizable value. So if you pick NRV 9,000, cost 12,000, which one is the lower? Is the 9,000. So the 9,000 is the lower, right? So that's the value that we'll be recording in our books. So that's all. When you are done, just sum it up. So the 10,000 plus 11,000 plus 9,000. Sum it, and then that'll be the value of inventory to be recorded in the books, and that should give us 30,000. So 30,000 is the value of inventory that we're going to record in our books. As simple as that. So we said the valuation should be done on a line by line basis, right? That's what the standard says. So if you pick product A, cost 10,000, NRV 12,000. So which one is the lower? 10. Then you pick. If you pick B, cost 11,000, NRV 15. Which one is the lower? It's still the cost. You pick 11,000. Then when you go to product C, cost 12,000, NRV 9,000. So the lower is the 9,000, which is the net realizable value. Pick it, and then sum all, and that's the value. See, if we're to use the total cost is 33,000, total NRV is what? 36,000. So we would have picked 33,000, but that's the lower, right? That's not what the sign is saying. The sign is saying we should not value it on total basis, but it should be valued line by line basis. Then let's look at question 10. So that's it with question 9. Let's see question 10. Okay. So let me move this one up here so that we can write question 10 here. Okay. So I have question 10. Okay. So question 10 says, let's go through one by one and look at the requirements, right? So the requirement says compute the valuation of what inventory of Safina Limited at December 31st, 2024 under IAS 2, right? So the requirement says, so let me bring it here so that maybe if you want to take a screenshot. So this is a question, right? Good. So the question says, Sarafina Limited is a retailer of Italian furniture and has 5 major product lines. Okay, has 5 major product lines. Okay, so we have the line sofa, tables, beds, closets, chairs. At 31st December 2024, quantity on hand, cost per unit, and net realizable value per unit of the product lines are as follows. So we have the products here, right? Sofa, table, bed, closets, and chairs. Then we have the quantities, we have the cost per unit, and the net realizable value also per unit, right? And we are looking at the value that I have to record in the books as the value of inventory. So here you have to value them one by one, right? Line by line. So we start with sofa. Okay. Now when you pick sofa, what is the cost? So when you pick something like the sofa, okay, what is the cost? And then what's the NRV? Just compare the two, okay. Then you pick the lower, that's all. Pick the cost, pick the NRV, then you compare, and then you have your lower, as simple as ABC. Right, so let me bring the Ghana city sign here so that we know that all our computations are in the Ghana city. Okay, so far, what is the cost? If you come here, you realize that the cost is what? 1,000, right? 1,000 Ghana cedis. NRV is 1,020. And I said this NRV is also in per unit. Okay, the question said up there that the cost and then the NRV are per unit. So this is the cost per unit, NRV per unit, right? So if you compare the two, the cost and NRV, you see that the cost is the lower, the 1,000 is the lower. So pick this 1,000 and come and multiply by the quantity, right? So it's as simple as ABC. So just this, open your bracket. Then our cost is what? So if you want, you can be working with the Ghana cedi signs, right? So this 1,000, but because we have the cedi sign up, we can equally eliminate it, the same thing. Just know that this 1,000 cedis is the cost, right? Which is the lower. Then you multiply it by the quantity. Okay, as simple as that. And that will give us a figure of, so we have 1,000 by 100 cedis. I'm sorry, 1,000 cedis by 100. The quantity is 100. So that'll give us 100 what? 1,000, right? So it's very simple. Pick the cost, pick the NRV. Somebody will do it this way. Somebody will compare, somebody will pick, I don't know, somebody do it this way. Somebody might decide to pick the cost per unit multiplied by the quantity. I following to get a total cost. Then that's this figure here. We'll pick this, right? And multiply it by the total cost. Pick this quantity, this 100,000 here, right? Sorry, this 100. Multiply it by 1,000. You'll get a total cost. Then we'll pick the same 100, go and multiply it by the 1,020 to get a total net realizable value before comparing, right? So the person might want to get a total cost and then come and then get the total net realizable value and compare. The same thing, but it's a waste of time, right? Why don't you just look at the two, compare, pick the lower and multiply by the quantity. This one is very fast. It goes faster, right? So somebody can do this way, multiply the quantity by the cost per unit to get total cost, quantity by net realizable value per unit to get total net realizable value before comparing. It's the same figure, right? I'll just compare and then pick my answer straight forward, right? So that's what I'm saying, that this place here, somebody can do it here, this place here, right? Somebody can do what I've said, we'll still get what? The answer, okay? So no matter how you do it, the answer, the value is what? Still the same. You get the same answer. So let's continue with our computations. The next item on the list is, sorry. So we have tables, right? So with the tables, we said, let's come here. The cost 500, net realizable value 450. So the lower is 450, which is the NRV. So that's 450 by 450 cedis by, what's the quantity? 200, right? 450 by 200, that's the quantity. Then you get 450 by 200, 90,000. Then the next item we are going to value is beds, right? So we have bed. Bed is also, if you check, the cost is 1,500, NRV is 1,600. So the lower is the cost is 1,500. So 1,500 by 300, right? And then that will give 1,500 by 300. That will give us 450 if I might be punching along, okay? So that I don't deceive you, or we don't get, wrong figures. But the most important thing is understanding. Okay, so just follow, and then the next item is we have our closets, and then with this one, the cost 750 NRV 770. So we are going to pick the lower 750. So we are going to pick the cost 750 and multiply by the quantity 400. This quantity here, you said you have 400 units. So you just pick and then you multiply by this 400 and then you are gone. So 750 by 400, 750 by 400 should give us 300,000. Okay. Then the next one is we have our chairs, right? And then the chairs, compare the cost 250 NRV 200. So we are going to use the lower, we use the 200. Then by the quantity, we have 500 chairs. So 200 CDs by 500, that gives us is it 100,000, right? So that should give us something like 100,000. So you just sum them 100,000, 90,000, 450,000, 300,000, 100,000. And then you underline, and then that'll be your total figure. So which is like 1,040,000, 1,040,000. So this is the value of inventory that we are going to record in the books of Sarafina Limited. Okay, then let's look at question 11. Let's also look at question 11. So let me go up here to the next page, right? Okay. So question 11. Okay. Okay, so question 11. Question 11 says, so this is a question. Let's look at the requirement, the same thing. Determine the value for each of the above items and the total value of inventory for the statement of financial position. So these are questions. Let's take it one by one. Okay. So it says Pierrot Furniture carried out its stock take at the end of its financial year. Included in its inventories are the following items. So let's value it one by one. Okay. So the first one says a table that cost the company 8,750 Ghana cedis. This type of table usually sells for 13,265, but it was damaged in a flood and will therefore be sold at a significant discount. It is expected to be sold for, or is expected to sell for 3,150. See, this is the normal selling price, 13,000 here. Okay, the normal selling price is what? 13,265. But because it was damaged, it can only be sold for what? 3,150, right? So if you want to get your NRV, it's the 3,150 that we are going to use, not this one. This is a normal selling price, but because it was damaged, it can be sold for this. So this is what we are going to use as selling price. Okay. And the cost is 8,750. So let's value them one by one. So let's come here, A, and then for A, we are valuing what? Tables, right? So let's pick that. What's the cost of the table? The cost is, so once again, let me put our CD sign up here so that we know that all the computations are there. Okay. So if you look at the first part, the A, right, the cost of the table is what? 8,750. 700 and what? 50, right? The net realizable value here, that here it's only the selling price or the amount at which we can sell the asset that's given to us. So 3,150. We are not giving any cost to cost that we are going to incur to sell or cost to repair anything, right? We're just giving the selling price. So that's all. We just pick these two and compare, right? So what value are we going to use? Looking at the cost and then the NRV, what value are we going to use? Which one is the lower? The lower is the proceed from selling, right? That is the net realizable value. So this is the value that we're going to record in our books, the lower of the two. Okay. So for this, the value we're going to record for what? Tables, right? Then that's all. I'm saying the 13,000, don't use it. Okay. I know we are not going to use it. Why? Because we were told that it might sell for 13,265, but because it was damaged, we can only sell it for what? 3,150. So that's what we're going to use. Then B, a wardrobe that cost the company 5,040 cedis, right? So we are told that a wardrobe cost the company this amount. So let me change my color once again. Okay, cost the company. So it's a cost price. And usually sells for what? 6,965. The wardrobe has been damaged and will cost approximately 840 cedis to repair, at which point it can be sold for 5,250. So once again, we have the cost here and then the selling price, right? But because we're told that it was damaged, this is the cost to repair. 840 is the cost that we're going to incur to repair. And after repair, to be sold at what? 5,250. So you see, we have two selling prices. Okay, the 6,965 and then the 5,250. But which one do we use? We have to use the 5,250 because that's the value, that's the amount at which it can be sold for after the repair, right? Good. So looking at this one here, B is, what are we valuing here? So let's write the name. B, we are valuing wardrobe, right? Okay. So let's value it. Its cost, what's the cost? In the question, each cost, the cost is, 5,040 cedis, right? Then the NRV here, the net realizable value will be, okay, the selling price, and, and I told you that here we have to use the 5,250, right? Not, we have to use the 5,250, not the 6,965. Right? We're told that after repair, it can be sold for only 5,250. So that is what the NRV, not the normal selling price. Okay. So we deduct 840. So 5,000, we pick the 5,250 minus the cost to repair, right? The 840. And after deducting, we are going to get 4,410. So picking these two, which one is the lower? So with the wardrobe, which one is the lower of the two? So for that one, the value will be the lower, which is 4,410. Okay, 4,410. That's the lower. So this is the value we're going to call for the wardrobe, the lower of the cost and then NRV. Then let's go to C. Okay, so let's go to C. See, we're told that a dresser that was made to a customer's own specification and cost the company 12,000, okay, 824 Ghana cedis to make. So that's the cost. Unfortunately, The customer went bankrupt and could not purchase the item. Due to the unusual design, the dresser was not easy to sell. After the year end, however, the company sold the dresser for 15,750 Ghana cedis, but incurred commission cost on the sale of 735 Ghana cedis and a delivery cost of 1,106 Ghana cedis. Now, if you look at this question, we've been given a cost straightforward here, and then they said they sold it after the year end, right? Now, even though it was sold after the year end, there's this standard IAS 10, right? Events after reporting date, right? It's the standard on its own, which says that we have adjusting events and we have non-adjusting what events. So it mentioned inventory write down as an adjusting event, even though this inventory was sold the following year, right? After the year end. Are you getting it? We are still going to use that selling price, that value, to value the inventory in the current year, because if we should sell it now, that's the amount we are going to get. That's the value. It tells us the value at the end of the year, right? So the value at which was sold the following year is the value of the inventory as at the end of the year, right? So these things are more covered. They are covered in under IAS 10. Probably we'll look at a video on IAS 10 and get to understand more. But the bottom line is that we have the selling price here. So let's come back here. Okay. So we have the cost. So we are valuing them one by one, right? So cost is 12,000. So we have the cost to be 12,824, right? Then the net realizable value, our NRV, we have the selling price, then less cost to sell, right? See, in this question, we have two, the cost to sell, we have two, right? We have the commission cost and the delivery cost, right? The commission cost of this 735, and then the delivery of what? 1,106. So just pick your selling price, which is 15,750 minus 15,750 minus the cost to sell, right? Cost, and the cost sell, we have two. So just less than, we have 750, sorry, we have 735, and then we also have 1,106. Okay. So we just have to deduct the two. Okay, so let me bring this one here. Let me bring this down. Okay, so the NRV, we have these two. The cost, okay, which is 15,750 minus 735 minus 1,106. Then when you deduct, you get 13,000. 909, 13,909 Ghana cedis, right? So comparing these two for the, okay, so see, let's name it. What item are we valuing? A dresser, right? So that one is a dresser. That's what we are valuing, right? Okay, so let me write it here. Dresser. So with the dresser, the cost is 12,824. 12,824, and then the net realizable value is what? 13,909. So the value would be the lower of the cost of this figure here, the lower of this cost here, and then this net realizable value. So if you pick the two, what's the lower? Right, so the lower will be the 12,824, right? So that will be the value in our books. Okay, that will be the value in our books. Okay. So that's it. Very, very simple. Very, very, very simple. Okay. Very, very simple. Just know the principles. Okay. So let me bold in this one so that we know the value. So we are done valuing the three inventories. So we have to just add them. Tables, the value was, we said this was the value 3,150, wardrobe 4,110, and then dresser 12,824. So we just put them together, and we have the total value of our inventory. So let's put it up here. So our total value of inventory, okay, will be equal to, so okay, so let me bring the total value down. So our total value will be the summation of the three, right? The 3,150 plus 4,410 plus 12,824. And then summing everything gives us 20,380, 20,384, 20,384 Ghana cedi. So this the total value of inventory. So when we are done, you just have to come and then value them. So you see, when we pick this one, okay, the table, the cost was this, right? NRV was this. So we said the lower of the two. So we pick this one. Are you following? Wardrobe cost was this. NRV was what? This, right? So the value is the lower, which is the 4,410. And then we came to the dresser. Cost was this, right? NRV, this was the cost. Dresser, this was the cost. NRV was what? This one, right? So if you compare the two, the lower is the 12,824. So this will be the value for the dresser. So we've been able to what? Determine the value of each of them as the question is saying, as is here, right? If you look at here, it says you determine the value of each of them here. We've done that. And then the total value, right? So when we are done, just sum them. And then you sum this one, sum this, right? Sum the values of each of them, and then you get a total value. So it's a value that we are going to record in our what? In our books. Let's try question 15. Okay. Let's go and try question 15. A simple question. So let's try question 15. Okay. So question 15 says, so let me bring this one up here. Okay. So let's write question 15. Okay. So it says equipment constructed. Equipment constructed for a customer for an agreed price of $18,000. This has recently been completed at a cost of $16,800. And it has now been discovered that in order to meet certain regulations, conversion with an extra cost of 4,200 will be required. The customer has accepted partial responsibility and agreed to meet half the extra cost. The requirement is we should determine the value of inventory that will be recorded in our books, right? So it says equipment constructed for a customer at an agreed price. So this $18,000 here is the price. I mean the selling price, right? That is sales proceed, and we are told that. Sorry. So okay, let's continue. So we're told that it was completed at the cost of. So this is the cost incurred to complete to do it. Like I following. The cost we incur to work on it, right? So this is the cost of the equipment, the cost. So we said the $18,000 is the selling price. It has been done for the customer at that price, and this is the cost to do it. And then we're told that there will be conversion with extra. So this is extra cost, which is like cost to complete in a way. Do you get it? Like cost to complete, something like that will be required because like before it can be sold, they have to meet certain regulations, and then that will bring extra cost, right? And is it the customer has taken or the customer has accepted partial responsibility and has agreed to meet half of the extra. So this figure here, right? This $4,200, that extra cost, this is the customer has agreed to take half of their cost. So we'll take half of what? That cost, right? So very simple, just find half of it, and that will be the conversion cost that the organization or we will be what? Taking. Are you following? So with question 15, it's very simple. The cost of let's bring our cost. What's the cost of the what is the cost of the equipment, right? But before that, still to make our work presentable, we have to have ours. Ghana city something there, right? So the cost of the equipment is 16,800. Don't forget that 16 what? $800. Okay, and then this is not the Ghana city sign, so let's rather get our dollar sign. Okay, okay. So Control C here. I come here and then Control V. Okay. So this is the cost. Then we said our net realizable value, NRV. How do we get the NRV? Yeah, right. So we said with the NRV, we pick selling price. Okay, what's the selling price? It will be sold at what? $18,000, right? Then we said if there's any cost to sell or any cost to complete, we will what? Less it, right? And we said in this question, we are going to pick half of the conversion cost, right? So we are not going to deduct the extra cost. We are not going to deduct everything, the 4,200, or just pick half of it, right? So here, very simple. Just pick your, so that will be half, right? By the 4,200. Are you following? And that will give us a figure of 2,100. So this is what we are going to use. 2,100 is what we are going to use as what? The extra cost that will be what? Incurring the conversion cost. Okay, not the whole thing, because the customer has agreed to take half of it. So when you deduct the 2,100 from 18,000, we will get 15,900. Okay, $15,900. And this is the NRV. So comparing the two, the cost and then the NRV, which one is bigger? Sorry, what's the lower? Because the standard says we should record it at the lower, at the lower of cost and NRV. So comparing the two, 15,900 is what? The lower. And then this becomes the value of inventory. There's nothing wrong with this question, or let me say this question is not difficult. What we should know is that the $18,000 is the proceed, or the amount we'll get from selling, or the selling price, right? And then the the 16,800 is a cost, because it has been completed at that cost. So that's the cost. Then we have conversion cost, right? Or an extra cost of 4,200. And even with that, we are told that the customer will take half of it, right? So we will take only the half. So we find half of the 4,200 and you get 2,000 what? 100. And that becomes your conversion cost, right? So if you want to get your NRV, your selling price or your sales proceed minus any conversion cost or any extra cost. So we just deduct and we have the 15,900. We pick the lower, right? So let me use this thing to explain the write down small. We've talked about event write down. In this question, you realize that there's a write down, right? There's a write down here because we said there's inventory write down when the cost is greater than the NRV. And it is true. Look at the cost. 16,800. NRV is what? 15,900. 15 what? 900. So there's a write down. Are you following? So the difference is the write down, right? And then we even learned what we do when there's what? A write down. We said when there's a write down, we would debit something and credit something. If you remember, if there's a write down, we would debit cost of sales and we credit what? Inventory, right? So the difference between the 16,800 and then the 15,900. Okay, so the difference between the 16 what? 800, 16,800 minus 5,900. Okay, which is 900 is the write down, right? And we said with that one, if you remember, we said we debit cost of sales with how much? The 900. Okay. So let me rewrite it here. So we said with that one, we'll debit, right? We'll debit our cost of sales with 900, and I will credit what? Inventory with what? 900. But I'm saying, if you watch the previous video, that you don't really have to do anything, right? You don't really have to do anything. If you're computing your cost of sales, just use this figure. Just use the 5,900 and automatically the 900 here, the difference will be added to your cost of sales, right? So this is something small about write down. So don't forget that, okay? And then even with question, okay, so this one, they were just individual stuff that we did, right? Okay, so that's question 15. Let's see if we can add another question. Let's solve another question. Let's look at question 19. Okay, what we saw right now was question 11. Okay, yeah, so let's look at question 15. Okay, 15 is what we just solved, right? 15 is what we just solved. Okay, so 19. So let's see if there's something. Let's see if question 19 can be. Okay, so let's look at 19. 7, 4, and 9 in another video, right? So let's look at them in another video. So let's pause here. Please, if you like the video and you are really following, please um just like my video, give me a thumbs up, like, share, subscribe, and then share with your friends, right? So I'll see you in the next video. That's the continuation of IAS 2. We are still solving more questions. So I'll see you in the next video.